thank you to the Old Mutual team for inviting me to participate in this wonderful Thought Leadership Forum this year. And it's terrific to be in front of you, quite an eclectic group of people who care deeply about the future of the retirement system in South Africa. So hopefully over the next 25 minutes, I'll take on a bit of a journey. It's going to be a challenge, but a great opportunity to try and take you through 3.5 odd decades of the modern Australian retirement income system, what we've done, why some of what we've done has held us in good stead, and we're routinely sort of looked at as one of the best defined contribution systems in the world. But equally, I want to highlight to you some of the things that that aren't so great about our system, where I think we can learn from other jurisdictions as well. But importantly, I think like a lot of things in life, what you learn from maybe the things that you could have, should have and would have done better are someone else's great insights and takeaways and learnings. And I think that is probably the value I hope to instill today as much as anything else. Gosh, I do have to update my photo. That was COVID. Did you have COVID beards? I'm from Melbourne. We were the most locked down city in the world at one point. We had months where we were locked down at home, and so on team meetings we all seemed to turn into cavemen again. But okay, so moving right along. Let me start with a good old framework. You are probably familiar with this, but it is the World Bank and the OECD have said that the better retirement income systems in the world have three significant pillars involved in those structures, and those are Pillar 1, a universal, usually taxpayer-funded or sovereign paid-for old age pension, acting largely as a safety net for the alleviance of poverty. Pillar 2, and this is the pillar I'm going to focus on probably the most today, is around a mandatory or voluntary private pension savings system. And thirdly is the pillar which is covers generally private wealth and assets which people can also use and deploy towards retirement. Okay, so let's have a look at how Australia fares against that framework and pillar. We have all three in play. We have an old age pension. It commences from age 67, so Australians can't qualify for it until age 67, both male and female. It's means tested, both assets and income means tested, and at its full payment, it equates to about 25% of average male weekly earnings in Australia. So by world standards, it's not too bad, but it does provide on its own a fairly basic level of retirement income. Pillar 2 is our superannuation pillar largely, and both employers supported, and I'll talk about that in a moment, and private contributions which are tax encouraged or incentivised are within that pillar. And Australians do tend to, particularly in the higher income brackets, personally top up what the employer is putting in for them. And then, of course, there's the personal savings pillar. And in Australia, home ownership is a very central part of that pillar. In Australia, your principal residence, it's like your own private Cayman Island. We have no inheritance tax or capital gains tax or any other tax that can impact your principal residence. So we do have a lot of Australians who are what I would call asset rich and income poor when it comes to retirement. They may have a home which has quite a lot of equity, and hopefully they've got a home, and if they've paid it off, they are sitting on quite a valuable asset. But how they monetise that in terms of retirement income is quite a challenge and a struggle, and something we're trying to work on with Australians. So let me now bring in the South African retirement system against those pillars. Straight away, you'll see three pillars are all in play. Like Australia, you too have an older age pension. But it's quite significantly different in terms of if we were to sort of bring this down to a comparator on US dollar terms, it's certainly a lot less than the Australian old age pension, although I believe it's also, there's means testing applied to it as well. Obviously, in Pillar 2, you do have superannuation, and you've probably come from more historically from a defined benefit background than Australia has. We have very little defined benefit in our world. We've mostly been a defined contribution country, but your transition from DB to DC is certainly well underway. But equally, you've got sort of a duality of economies, and the formal economy and the more informal economy, and how that plays out differently we'll talk about a little bit as well. And of course, private savings and the like are no doubt in play there. So, first and foremost, we both ladder up to the OECD World Bank model there. Okay, sorry about this very busy slide, and I'm not quite sure whether we are making slides available to everyone afterwards, but if not, we are, I'm getting the nod, so don't worry if you didn't catch a particular piece of detail, these will be made available to you. Okay, so what I've tried to do here is capture in the left-hand column the general features of a well-performing retirement income system. And I've sort of then plotted South Africa and Australia side by side in terms of a bit of a broad comparison. I've highlighted and read the things that I think really are a little bit, there's a bit of a moat between the differences between the two there. But suffice to say, Australia's system can probably be summed up as being slightly more comprehensive and down that road of evolution and maturity. And it's underpinned by compulsory savings and contributions, and I'll talk about that in a moment because that's really the secret sauce. That's almost our superpower when it comes to the Australian system. South Africa, it currently faces some challenges, particularly in coverage, preservation, although a huge leap has been made there in recent times with the two-pot approach, and adequacy. And I think a lot of countries in the world probably are challenged by that last one, adequacy. And I'll talk a bit about how Australia has looked at that and what learnings or lessons in that South Africa might consider in terms of its future state. I did mention earlier, so your two-pot reform, which has nearly reached its first birthday in September, that was a great move, I think, to be able to, at the same time, ensure that people have some access to needed savings at a given point in time without everything being squared away for potentially decades, but the majority of it being that for the benefit of retirement savings was a good approach. Startlingly, 43% of Australians today don't have $1,000 in their savings account. Keep that in mind when I show you what's in their superannuation pots, because it's a hell of a lot more. But in terms of if the refrigerator broke or the hot water system needed replaces, they would struggle to address that. So actually I think there's some learnings that Australia can take out of what countries such as South Africa have done in terms of finding a balance there. And there's of course that increasing focus on preservation as well. Okay, let me talk about the superannuation guarantee. This is at the core of the Australian superannuation system. And I'll take you on a very quick journey on its evolution. So back in the 1980s, early 1980s, unless you worked for the public sector or a large government instrumentality, or a large large corporate business, very few Australians had superannuation. And if they did, it was off their own volition, not an employer's or a government initiative. At the time, in the mid-1980s, the unions were pushing very hard for a national wage increase, which was deserved. But we had inflation of about 13 to 14% at the time. The government did not want to see a national pay rise basically be spent in the economy at that time. It was going to be adding to inflation. So the government of the day sat down And we had a very visionary Prime Minister at that point in time who was very nation-building and very forward-thinking. He sat down with the head of our unions at that time, and between them, they came up with a plan which they then took to their respective sides of things, and it was called the Accord. And it was basically to pay that 3% pay rise, but to not pay it as cash in hand, but to pay it forward as deferred income paid into superannuation for people's retirement. That took a lot of argy-bargy. The employers, of course, said, no, this is ridiculous, we can't afford it, etc. We got there. So in the mid-1980s, it was called the 3% productivity benefit was born. However, fast forward to about the end of the 80s, the 3% productivity benefit was patchy. Compliance was very ordinary. There were numbers of sectors and industries that actually didn't sort of really get the 3% productivity properly paid through, and it was quite inefficient in many ways. So again, that same government, that same Prime Minister and that same leader of our national peak union body decided they had to give this teeth. And what was developed was the superannuation guarantee. So effectively, they went to the smartest people in government and said, how can we enforce the payment of superannuation for people? And they said, well, we went all the way back to the Constitution, and the government has taxation powers that it can levy against employers, use those powers. So our superannuation, compulsory superannuation, is actually based on our taxation law powers. So the government, if an employer doesn't pay contributions as it's meant to, it will whack that employer with quite punitive tax penalties and other measures. So if they basically don't comply, they will comply ultimately, but the hard way. So back in 1992, Super Guarantee kicked off and it inherited the 3% productivity benefit as its starting point. We then had a roadmap, and I emphasise a roadmap, this is really important. In all the good pension systems in the world in terms of their adequacy and where they sit today, Iceland, the Nordics, Netherlands, they have got there because they set out a roadmap and they took people, the whole country on a journey. You know, if you've got a destination you want to get to, without a map, you'll wander all over the place. Same thing. Bear that in mind because I think that's one of the ingredients for South Africa to give some strong thought to as it thinks about its future in terms of adequacy. We set a roadmap and that was to incrementally increase that to 9% in 10 years. And we did it, we achieved that. We then drifted sideways for a long part of the early 2000s. I won't take you through the boring details of that, but we had what I call the superannuation wars. We had political parties arguing and fighting over whether we should increase it, decrease it. A whole heap of things went on during that period of time. But the Labor government, who had introduced this back in 92, about midway through the 2010s, took evidence that from an adequacy point of view, 9% was not going to cut it. People were still going to be retiring with inadequate retirement savings outcomes. So we set another roadmap, this one to take us to 9%. There was some talk about 15%, but that got knocked on the head. There was a bridge too far at the time. And so we ratcheted up over the last few years to 12%. And we achieved 12% last month, on the 1st of July 2025. So let me just overlay that roadmap with the national savings pool. Now, Adrian made a really great point earlier in terms of the six-pack. One of the key ingredients there was national savings. Now, whilst I just mentioned that nearly half of Australians couldn't put their hands on $1,000 if they needed it to tomorrow, it's very different about their superannuation. We have the second largest pool of national savings in the world behind the USA. It's reached now $4.2 trillion of collective superannuation savings. So if my math's correct, that's going to be around about 49 trillion rand. That's terrific, and that's compounding along very nicely. But the great utility of this, and this is one of the great spin-offs of this pool, is It's also created significant benefits for the nation's economy in terms of it provides stable, long-term source of domestic capital that can be deployed by pension funds in ways that invest in core infrastructure, innovation, business, and it reduces our reliance on foreign funding. This pool also helps deepen Australia's financial markets and its resilience to economic storms, of which we suffer a few contemporary. And it really does promote self-sufficiency in the mindset of Australians in terms of retirement. And importantly, it is going to do the heavy lifting in easing the national old age pension outlays in coming years. So it's very much, per Adrian's comment earlier, one of the significant parts of our six-pack. Okay, we're 35 odd years into this modern superannuation journey, but we are not an overnight success and we have to continue to work at things. I've highlighted here a number of the really key reforms, whether they have come from policymakers, regulators, or the industry itself in self-determining some of this. In the limited time I've got, I've just highlighted here in red a couple of the things that I think really were part of the biggest step changes in our journey. And I'll just very quickly skate over these, but the Your Future, Your Super reform, that was a wonderful name that was given to those reforms back in 2021. Amongst a range of things, it included a bright line performance test. So in Australia now, pension funds or superannuation funds are subjected to an annual performance test by our regulator. I can talk a little bit more maybe in the panel about how that performance test works. You do not want to fail that performance test. It's very onerous. If you were declared an underperforming superannuation fund, and it's not on a year-to-year basis, any fund can have an ordinary year, it's on a rolling 10-year basis. But you underperform and you have a probation period to fix that. If you don't, and if you fail that performance test twice in a row, you're out of business. So we can talk a little bit about that more later, but that has done quite a lot to lift governance in Australian pension funds and performance and really focused on net benefit return. SuperStream, this is really important. SuperStream is the pipes and the wires of the house of Australian retirement. In hindsight, we should have done this a hell of a lot earlier, okay, because it's been the enabler for so many other things. So SuperStream is when the industry got together and developed our version of the banking superhighway, the way money moves around the system and data. Going back not so many years, if you moved money between Australian super funds, it could take up to 90 days. A lot of friction involved there. Today, if it's not moved in 2 business days, there's a please explain from the tax office to that superannuation fund. And I'll talk a little bit about some other things that's enabled as well, but that was really important, getting the pipes and wires in place earlier. MyGov, our Australian Taxation Office, is the all-seeing eye. It knows where every Australian superannuation is, and it can show you at the click of several mouse clicks on the website. As an Australian, we all have a unique identifier number. It's our tax file number. I can use that number. I can go to the tax office. I can look up the MyGov site. It's like your own dashboard. It'll show me where my superannuation is, and it's a functional dashboard. I can consolidate accounts. I can move money between accounts if I wanted to. And the messaging via SuperStream from that goes to those funds and says, you've got 2 days to make this happen, guys. It's quite an efficient system these days. Stapling. Let me talk quickly about stapling. This is a recent one. As a concept, stapling, it's what it is. It's joining 2 things together. We had a terrible situation going back 10 or 15 years ago. People moved between jobs in Australia and they would start a new superannuation account every time they moved. By the way, the average Australian moves 16 times in their working life. At one point, we had an average of 5 superannuation accounts per person, per every Australian. And when you ask those people, did they know about those 5 pots? You're lucky if they could even name one of them. So we had lots of lost money, lots of multiple accounts, multiple administration fees, not very efficient and effective. We took a decision only several years ago. We cleaned up a lot with SuperStream and that. We cleaned up a lot of the old historical accounts. So today, or since 2022, when an Australian joins the workforce for the first time, comes into superannuation for the first time, the employer says to them, where do you want your superannuation paid to? Now, very deliberately, it's where do you want your super paid to? The member is at the top of the choice totem pole. In Australia, it's the individual who picks their superannuation fund. If they choose not to, many choose not to because they don't understand the system, the employer will enrol them in the fund that they have chosen for the workplace. But once you are in a fund, whether you chose it or the employer put you in it, you are stapled to that fund. And as you move through your life from different jobs, different employers, the conversation will be, what superannuation fund are you with? That's the fund I have to pay my contributions to. Unless you choose to unstaple yourself and reattach yourself to another fund, and you can do that. But that's the member's call, not the employer's call. Effectively, one pot at a time, and pot follows member. That has done a huge amount of difference in terms of cleaning up the multiplicity of accounts in a pots. And the other great side benefit of it, the general national financial literacy of members and their engagement with superannuation has gone up accordingly as well. Okay, I'm going to run out of time. I'm going to go really quickly through the rest because I've probably dallied on a few of these points. Consolidation. This is really critical. And on the left-hand side is the Australian experience. So I've only gone back to the year 2000, but we had about 4,000 funds roaming the landscape at that point in time. As you can see, over a not long period, that really came down rapidly. And that was the clean-up of particularly a lot of old corporate accounts or corporate super funds where the businesses were not really, didn't have their heart in running superannuation anymore. Governance standards were really ratcheted up for trustees and for funds. So there was a bit of a natural attrition there and a sort of a Darwinian experience. And then there's been a range of other reforms, particularly in the more recent times, to keep that number coming down. And mergers in the last 5 years, there are 40% less super funds in Australia than there were 5 years ago. We sit at around about 60 odd large, what we call my super funds. These are licensed by our regulator to take that super guarantee money. I think there's about 13 mergers probably likely to happen in the next 12 months. I suspect by the end of the decade, we'll be down to about 20 to 30 funds. Now, compare that to South Africa. In terms of the trend, remarkably similar. And I understand and I know now that your regulator's doing a pound of work to clean up a lot of old and legacy funds and accounts and the like. But look at the scale difference. We were about 4,000 funds back at the start of the millennium. You were over, or 16,000, but today there's still hundreds and hundreds and hundreds and hundreds of funds. I wouldn't be surprised if that's going to be an area of focus in terms of bringing that down to a lower number and scale benefit, hopefully, lifting and improving member outcomes there. But we'll see. But I thought that was quite interesting to compare and contrast the two, particularly, but the scales are very significantly different. Very quickly, there are 8 superannuation funds in Australia who are what we would call mega funds. They're actually all industry funds or sector funds. They're all actually profit to member funds, but there are some very significant, bank and insurance owned funds in Australia too. The point I want to make here is 8 funds run and look after 65% of that $4.2 trillion. Most of that money is concentrated in 8 funds. Now, these funds are hopefully deploying that scale wisely, and the regulators have regular conversations with them about that to make sure that they are. But whilst the cost to serve members and administration costs and that are coming down, so scale benefit is generally evidenced, we are running into another problem. It's a nice problem to have in some respects, but we're running into some diseconomies of scale issues. Some of these funds are getting so big that, for instance, 25% of our listed stock market, the Australian stock market, 25% is owned by members in these 8 funds. Our stock market represents 1.6, 1.7% of all listed markets in the world. We're running out of domestic investments to put this money in, which is why Australians and Canadians and Nordics, you'll see us roaming the world with big checkbooks, looking to buy tier 1 assets wherever we can find them, because we're running out of room at home in terms of hitting some diseconomies of scale. And as I said, that pool of money gives us a sizable checkbook, as I put it, to go hunting for the world's best assets for members in their retirement. I've mentioned a couple of times about outcomes and that. In Australia, we've sort of landed on one KPI, one measure that rules them all, and it's net benefit outcome. Costs are important, don't get me wrong, but at the end of the day, what really matters to members is what hits their account, what they'll touch, feel, eat, spend in retirement. Even our regulator and our performance test is underpinned by net benefit outcome. And this is a great leveller because scale isn't the be-all and end-all. I know some rather small funds in Australia who deliver great net benefit outcome. So if you were to measure, are you doing what's on the tin in terms of delivering for your member, they are doing that, but they don't have the scale of those other 8 funds. There are some very significant funds, including, I won't mention, one of those big 8 funds that I would say, and on a net benefit return basis, are not doing so well in terms of deploying that scale to deliver that outcome. So scale is important, used wisely, but we've actually found that that's not the right measure and that's not the right thing to hang your hat on in terms of a quality retirement institutional scheme. It's the net benefit outcome that you deliver. And by the way, that's really understandable down the pub. You can talk to an average Australian about net benefit outcome. They sort of get that. It's like, what's the drive-away outcome? When you start talking to them about risk-adjusted returns and Sharpe ratios, you lose them, of course. Okay, very quickly, how have we gone over this 33-year journey since we moved to super guarantee? Very quickly, we've done pretty well. Mind you, we have lived through extraordinary times in those last 3 decades, globally. Some Australians today who've lived through this period actually die with more in their pension account than when they retired. It sounds a bit perverse, but that's the situation with some lucky people. So the amalgam of all of those today, 60-odd 7 funds left, their median return was around about 7.2%, the median, 7.2. Inflation over that same period was 2.5%. So the driveway outcome is that the broad Australian superannuation super market has delivered 4.7% real return over 3.5 decades. Not bad. And it has delivered what it said it would do. The red years, the 5 years that the nation underperformed, there were some pretty interesting things going on in the world at the time. We had the dot-com bust boom in 2002. We had the GFC in that 2008 period. And more recently, we had a pandemic. So there were a few other macro things going on which also contributed to that. I'm going to sail through these pretty quickly now because I'm now impinging, I think, on others' time. But now considering what have been Australia's strengths and what relevance does that maybe have to South Africa, I think making superannuation compulsory is a conversation, a national conversation that's worth having for some of the reasons that I've pointed out earlier, particularly in the formal sector. Preserving superannuation to retirement is really important. You've taken some very large steps in that direction, and I think that's going to be very positive for you. Making superannuation as universal as possible, trying to reach as many people in the country as possible, and having superannuation as part of their life and world, I think is a very laudable goal for South Africa to continue to pursue. So, in terms of what might South Africa sort of choose to prioritise and focus on, I think then considering the introduction of mandatory contributions is important. Preservation, tick, we've talked about that. Building the digital infrastructure, and by that I'm talking about the super stream, making sure that the pipes and wires are in place to enable you to build on these other initiatives such as Australia has. Expanding the country's level of financial literacy and retirement literacy. Financial literacy and retirement literacy are actually slightly different. We need to lift the broad financial literacy, but as people approach retirement, having conversations about retirement and how that works is very important. Even as we've seen from some of the videos and outside, if you even just take what Old Mutual has done with things like using WhatsApp to engage with people, that I think is fantastic. Taking this annuitisation approach. So superannuation accounts are just a means to an end, and that's a retirement income. Australians are very lump sum thinking and orientated people. We need to do a lot more work in the annuitisation space. I think your approach is reasonable in terms of making that sort of more the default discussion and starting point rather than a lump sum. Interesting, in the UK 12 years ago, they moved away from annuitisation as default. Do what you like with your money. Take it all as a lump sum if you like. There's active conversation in the UK now about going back to the old ways because the outcomes for members just aren't quite the same. I think I touched on some of this earlier, but in terms of some gratuitous advice in terms of the journey, I think, look, as the case was in Australia, setting a vision, drawing a roadmap, gathering the whole village around that, and it's going to take everyone. It's going to take Labor, it's going to take employers, it's going to take regulators, policymakers. The whole village has to come together to make this work. Looking to try and make it compulsory, and I'm having a stab in the dark here, maybe by looking at that initially in the more formal sector with maybe something akin to an auto-enrolment type situation for the more informal sector, but with a view to extending the boundaries out over time, maybe an approach to that. I think I've probably covered all those other points there as well. Okay, so just finally, and in conclusion, we don't have all the answers. Far from it. We've got a lot of scar tissue, as you've seen on some of that 35-year journey, and I think that's what we can best do in terms of sharing those experiences with other jurisdictions. What could we have done differently? What should we have done in a different order? If we had our time again, if we were that pension minister for half an hour, what decisions would we make that would improve those systems? I think we've got a lot to add. I'm very ambitious and hopeful and confident for the South African future in terms of this. One of the other things in that six-pack that you have that we lack is a young population. And long-term patient capital thrives on younger populations. We did have that 35 years ago. Our birth rate has dropped dramatically. Our ageing rate has increased a lot. That's a big problem for us. We're going to have to deal with that. We're going to have to get that one back in the six-pack. Maybe baby bonuses will start to be paid. I don't know. We'll see how we go. But my final point is, and I'll sum it up with those words, don't compare your beginning to someone else's middle. Because if you do that, you might feel it's all too hard, it's too much of a journey, how are we going to corral all of these people and get consensus? We were in the same boat some way back. So you're off to a great start. I think it's a very bright future, and hopefully Australia, and hopefully British, we can export some benefit to South Africa, can help you on that journey. I'll pause there, and I'm sorry, panel, for impinging into your time. I think the panel will have some very interesting discussions about this, and I'll come back and join maybe later as well. Thank you so much.